Good morning everyone. Welcome to our Smart Learning video note for corporate finance. Today, we will present Chapter 10, Making Capital Investment Decision for a Realistic Corporate Finance Scenario. We will demonstrate how firms evaluate investment projects using capital budgeting technique.
As our production costs continue to increase, we are considering investing in a new automated production machine. However, this investment requires a significant upfront cost. Before proceeding, we must evaluate whether this project will add value to the company. I would like a finance team to conduct a capital budgeting analysis for this project. Please focus on the relevant cash flows and apply appropriate financial evaluation methods.
In capital budgeting, we focus only on incremental cash flow, which are cash flows that occur only if the project is accepted. Sunk costs are excluded because they have already been incurred. Financing costs are also excluded, as they are reflected in the required rate of return. This approach follows the standalone principle. Types of project cash flows. In capital budgeting, project cash flows can be organized using a flowchart structure. At the start of the project, we consider the initial investment, which represents the cash outflow required to begin the project. During the life of the project, the firm generates annual operating cash flows from its normal business activities. At the same time, we account for changes in net working capital such as additional inventory or cash tied up in operations. Finally, at the end of the projects, we include terminal cash flows, which may consist of recovered working capital or salvage value. All project cash flows are evaluated on an after-tax basis. Operating cash flow represents the cash generated from the firm's normal operations. Using the bottom-up approach, operating cash flow is calculated as EBIT multiplied by 1 minus the tax rate, plus depreciation. Let's break it down step by step. EBIT, or earnings before interest and taxes, represents the project's operating profit before financing and tax effect. We then multiply EBIT by 1 minus tax rate to determine the project's after-tax operating profit. Next, we add back depreciation. Although depreciation is a non-cash expense, it reduces taxable income. This reduction in tax creates what is known as a depreciation tax shield, which increases the project's cash flow. Therefore, it has a positive effect on operating cash flow through tax savings. It has a positive effect on operating cash flow through tax savings. Operating cash flow reflects the project's true cash-generating ability by combining after-tax operating profit with the tax benefits of depreciation. Based on our financial estimates, the project requires an initial investment of $110,000, which will be paid at the beginning of the project. Over the life of the project, the machine is expected to generate annual operating cash flows of $51,780. The project has an estimated life of 3 years, during which these operating cash flows are assumed to remain constant each year. To evaluate the project, we apply a discount rate of 20%, which represents the firm's required rate of return, reflecting the risk of the project. In addition, a corporate tax rate of 34% is used to ensure that all cash flows are evaluated on an after-tax basis. These financial figures will be used to construct the project's cash flow timeline and to perform the net present value and internal rate of return analysis. To better understanding of the project's cash flow, we present the information using a cash flow timeline. The timeline helps us visualize when cash inflows and outflows occur, which is essential in capital budgeting because the value of money changes over time. At year 0, the project requires an initial cash outflow of $110,000. This represents the cost of purchasing and installing the automated production machine. Moving to year 1, the project begins generating operating cash flows of $51,780. These cash inflows come from the machine's normal operating activities. In year 2, the project continues to generate the same operating cash flow of $51,780, indicating stable performance during the project life. Finally, in year 3, this project generates a total cash inflow of $71,780. This amount includes the annual operating cash flow, as well as the recovery of net working capital at the end of the project. By laying out the cash flows on a timeline, we can clearly see the pattern of cash movements over time. This timeline will be used to calculate internal rate of return in the next step of the analysis. After identifying the project's cash flow and constructing the cash flow timeline, we can now evaluate the project using capital budgeting techniques. The first method we apply is the net present value, or NPV. By discounting the project's future cash flows at the required rate of return of 20%, we calculate an NPV of positive $10,648. A positive net present value indicates that the project is expected to generate returns above the firm's required rate of return. This means that the project adds value to the company and increases shareholder wealth. In addition to NPV, we also evaluate the project using the internal rate of return, or IRR. The IRR represents the discount rate at which the project's NPV equals 0. For this project, the internal rate of return is approximately 25.8%. Since the IRR is higher than the required return of 20%, this result supports the decision suggested by the NPV analysis. Together, the NPV and IRR results consistently indicate that the project is financially acceptable. Well, there any questions so far?
Yes, based on analysis. I notice that the net present value of this project is positive. Does a positive net present value mean that the project will add value to the company?
Yes. A positive net present value indicates that the project's expected returns exceed the firm's required rate of return. In other words, after recovering the initial investment and accounting for the time value of money, the project still generates additional value for the company.
I also see that the internal rate of return is higher than our required return. How should we interpret this result?
The internal rate of return represents the project's expected rate of return. Since the IRR of 25.8% exceeds our required return of 20%, it suggests that the project earns more than what investors demand for its level of risk.
So, if both NPV and IRR provide positive signals, does that strengthen the decision?
Exactly. When both NPV and IRR lead to the same conclusion, it increases our confidence in the decision. The position NPV shows that value is created, while IRR confirms that the return is sufficient.
Based on this discussion, it appears that the project is financially acceptable.
That is correct. From capital budgeting perspective, the results clearly support accepting project.
Thank you for the detailed analysis and discussion. Based on the capital budgeting results presented, we have carefully evaluated this investment proposal using net present value and internal rate of return. When both NPV and IRR point to the same conclusion, it strengthens our confidence in the decision. Therefore, based on these financial considerations, we will accept the project and proceed with the investment.